I didn't do part C on number 8.
Yeah, you know the stock split. Is that no journal?
Oh, there's a stock split. I apologize. Okay, yeah, let's do that. So, finishing up number 8 from the practice test from whatever summer that was, 2013, I guess. Yeah, so we'll finish up number 8, part C. There was a stock split. I apologize. Instead, assume a 10-for-1 split. Okay, if there's a stock split, what is your journal entry, guys? None. No. So all you do for part C is you would put down no entry. Okay, got the points. Okay, but why? What happens? How many shares do we have authorized? And I might ask for this. How many shares were authorized in this round? Was it 1 million?
Yeah.
This is assuming we haven't done the splits, or done the stock dividends, right? So before, each one is independent one. Okay, so 1 million shares. How many are issued?
750.
How many are unissued? It's 250, the difference, right? How many are treasury stock?
50.
How many are outstanding, obviously, if you issued 750 or 50 treasury stock? 700,000? Thanks for asking me to do this, okay? Okay, outstanding 700,000? Okay, what's the par?
$50.
What's the market value? It's $12, wasn't it? You don't have to have that information to work this. Okay, so this is before, right? This is now. Let's do a 10-to-1 split. What is the balance right now? Split. Okay. What's the balance right now, guys, in common stock? 1.5 million? 750,000 times $2, right? It's 1.5 million. What's it going to be after the split? I'm not making a journal entry. It's going to be 1.5 million, right? Everybody agree? Okay, I'm doing a 10-to-1 split. How many are authorized now? So I filed an amended articles of incorporation with the state. That's what I'm doing, right? An amendment to my articles of incorporation. And I say, can I have 10 million shares instead of 1 million authorized? What does the state say? Because you're going to issue more shares. Promote business activity. Say, go for it. Yes?
Do you split your treasury stock?
Yeah, in splits you do. Yes, this is not a dividend. This is a split. There's a big difference. But no journal entry. Another question? Or? Yeah. So what's going to happen? I'm going to get the state's going to say, sure, you can do 10 million instead. So this becomes 10 million, okay? And then everybody that I've issued a share to, including myself, right? Because I'm holding the treasury stocks, right? I'm going to have 10 times as many of them, right? So everybody gives me their shares back, and for each share they give me, I give them 10. Got the idea? So if somebody owns 1,000 shares, now they own 10,000. That's all. Okay? So this is going to be what? 7,500,000? 10 times as many. And same with me. I'm holding 50,000, but now they are how many? Yeah. I give myself 10 for every one.
What's the thing you're writing on the side? SH?
Shares.
Oh, shit.
Okay? Shares. All right, 500,000. So how many are outstanding, obviously? 7 million less 500,000 is 7 million, which of course is 10 times 700,000. Worked out real nice, didn't it? Okay? What do you think your par value would be now?
$27.
You'd be $2 divided by 10, 20 cents per share. Okay, everybody, take 20 cents times the 7,500,000. And what amount do you get? 1,500,000. What was it before? 1,500,000. What is it now? 1,500,000. What kind of a journal entry do you need? None. Got it? What do you think will probably happen in the market then? There's 10 times as many shares out there, you guys, so it's probably going to happen.
Probably go down $1.
Let's go down to $1.20. Now, why would anybody do that? It doesn't have, it wouldn't exactly go down to $1.20. It might be more, it might be less, right? Because the market price is changing all the time anyway. And there might be some information in this, issuing the new shares. Maybe you're positive about the future or something, right? I don't know. Why would companies do this? Usually not when the value is $12 a share, but if the value is $100 a share, they might do a 10-to-1 split because people like to own a lot of shares instead of a few shares, even though it's the same investment. This is silly. I don't understand it. If I can buy 1,000 shares for how much? If I'm going to pay $12 a share, how much am I going to have to pay to get 1,000 shares? $12,000, right? But if I spend $12,000 over here, how many shares will I get? Not 1,000, I get 10,000 shares. Well, then I can say I own 10,000 shares of the company instead of 1,000. Who cares? It's the same investment, right? Either way, it's the same investment, isn't it? Well, you got the idea? There is some validity to it, though. If companies never split their stock, imagine how much it would be worth. Microsoft, if they never split their stock. They start with a few thousand shares. Company's worth billions of dollars. What would each share be worth? Nobody could buy one, right? And it just keeps going up in value, up in value, up in value. So you do splits, and it brings it down. You do splits again, and it brings it down. So over the years, companies split over and over and over. And what you'll see companies with 1 cent per share par values. That's because they've done so many splits, right? You keep splitting and splitting and splitting, it gets smaller and smaller and smaller. Got the idea? So, that doesn't mean anything. That's where you're at. Everybody good? That's a useful thing to know. By the way, when you're analyzing companies, you have to watch for stock splits. And for large stock dividends. Why? Because when you're comparing one year to the other, if there's 10 times as many shares, earnings per share, which, by the way, I don't like the earnings per share measure very much. Why? Because it depends how many shares you have. If I do a 10-to-1 split, my earnings per share is 1/10 as much, right? Everybody got the idea? I don't like those measures very well. I don't like the price-earnings ratio very well either. What's the PE ratio, price-earnings ratio, that you're learning for this, taking a look at for this? What is price-earnings, guys? Gals. What's price-earnings ratio?
Market price divided by earnings per share.
So it's the market price per share divided by earnings per share. I got another formula for you that'll do the same thing. That's price over earnings. Oh, wow. I don't know if I can remember this one or not. A PE ratio is the price over the earnings. You know, the price over the earnings. I don't think you have to memorize that, do you? You could do it this way. How about market cap, it's called. That's an R. Market cap over net income. What am I doing here, you guys? That's a PE ratio too, price earnings. Everybody calls it PE ratio. You need to know what this ratio is because people talk about it all the time. Oh, the PE ratio is a certain number. I kind of think, oh, that's nice. Okay. Market cap. What's that? It's the number of outstanding shares times the market value per share. This is the total market value of the company. This is their total net income. Yeah. Price, total market value divided by the net income is the price earnings ratio. It's the relative size of your income. That's what earnings per share is your share, right? If you have one share, divided into the market price per share. So what multiple am I paying? This is also called a multiple. And it's useful if you know why the price is what it is and what made the earnings be what they are. How do you know anything about what the price should be and what the earnings are and that kind of thing? You have to be very knowledgeable about the company. You have to have read the financial statements, right? You'll have to have followed the stock for a period of time probably, find out what's going on out in the market relative to that company and why the price is what it is. So what good does it do you to see that a PE ratio, here you go, I got a PE ratio, here's one company is a 10, another company is a 5, and let's have another company be a 20. You tell me what that means. What does it mean? It means the market price is, in this case, 10 times what the earnings per share are. Got it, guys? It means here it's only 5 times as much. Here it's 20 times as much. Which stock would you prefer to invest in? Based on this information, I don't have a clue. And you'll have stockbrokers tell you, oh, the PE ratio is a certain number, so it's a good deal. What? No. Okay, what could be happening to have 10 times? What if the stock is selling for $10 a share and its earnings per share is $1? And that's what we've got here, and that's why it's 10. Is that good or bad? Well, it could be that the market thinks this price, this earnings per share is going to go up really fast. So I'm paying 10 times the earnings per share, but I don't think it's going to take me 10 years to recover, right, in earnings, right, to get my investment back. I think that's going to grow. So that'd be good news, huh? You know what else could be the case? Maybe they used to have really good earnings, and the bottom fell out on it. And it's a mess, right? But the market hasn't realized how bad it is yet, so it's still at $10. But that's probably going to go down, right, as your earnings keep going down. That's awful, to be 10 to 1. Oh, what might 5 to 1 mean? Maybe it's selling for $5 a share and you got $1 earnings, right? Market price is 5, it's 1. And the market just hasn't realized yet, right, that this has been taken off. They don't believe it yet, but you think it's going to keep going, right? So when the market realizes it, what's going to happen? We might go to $2, but the market might go to $20, and now I've really made out big time, right? Because I can buy it for 5 and it goes to 20 and I made a fortune, right? It might be good news that it's 5 to 1. Or it might be that it's a very stable company that just keeps plugging along, right? And everybody thinks, well, it's going to stay this way indefinitely, and it's fairly low risk, it's all right, that'll be fine. Okay? What does it mean, PE ratio? Nothing without background information, okay? So I encourage you, don't use it until you really know what you're doing. And if somebody suggests to you should invest in a stock because of a PE ratio, ask them why the PE ratio is what it is. And if they can't, and where it's going now, if they can't answer that question, don't do business with them. Just get a different person as an advisor. You should be advising yourself then. If all you're going to do is guess. Look at some number. You can look up the PE ratios for free. You don't need an advisor to look them up for you. And you could know nothing too, right? That way too. Okay. And 20 would be the same thing, huh? What could 20 be? Selling for $20 a share and it's only earning $1 a year. What, are they going to wait 20 years? No, they think it's going to grow, right? Or the reverse, the bottom's fallen out and hasn't gone down yet, which could, with the explanation I gave there, huh? 10. Only it's even worse, maybe, or even more coming in the future. For high-tech stocks, what do you think their PE ratios look like? They've never made any money, and it's still selling for a positive amount. What do you think? .com companies and stuff. People think there's a big future, right? That's what's going on. So blue chip companies.
All of these calculated.
We can calculate it moment to moment. Stock prices are changing,
Okay.
and you've got earnings per share being reported quarterly.
So calculate each time the share.
Every time there's earnings per share, absolutely.
Okay.
Yeah. Actually, every time the market price changes even.
That changes like
The new PE ratio. Because the market price per share is changing constantly, right?
Mm.
All the time trading's going on. The earnings per share you'd only don't know a new one when it's reported. That makes sense?
Mm.
So the earnings per share is historical data and the market price per share is current data. Historical data and current data merged together, what do you think? Not very good. Okay, that's all we got, so we use it. I don't know why I got on that, but it's all right. It's useful to know.
So like out of all these, which ones are really useful? People like actually use.
Oh, people use price earnings ratio all the time. They use all of them. And if you really know the company, price earnings is a really fast way to communicate. If you and I had evaluated a whole bunch of companies, we could talk about what the PE ratios are and what we like and what we don't like. It'd be just fine.
So it's
it's
an
just,
easier way of like, instead of talking about everything, like you can just kind of summarize it in one, if you know what you're talking
is there a oh no, there's not one ratio that captures everything.
about.
That's not true. But I like current ratio. I think it's good. I like accounts receivable turnover, inventory turnover. I can use those to make decisions in the business. I certainly like return on investment, return on assets, things like that. Absolutely, sure. Okay. compare one company to another. What ratios do is it standardizes across different size companies. So you have a real big company, a smaller company in the same industry, and compare them. And looking at just their dollars income doesn't mean anything because one's big and one's small, right? Or their total assets or something doesn't really mean anything. But the ratios converted into a percentage instead, basically. Makes sense. So they're kind of handy. It's also they're also really useful to compare 1 year to the next, right? Over time, what's happening with your company. Your current ratio is getting better or worse or something, or your average, or the times interest earned is getting real small or getting real large or whatever. You can see what's going on there. Okay, should we do some investment stuff? Number 9? Why not? Bag Corporation recorded the following journal entries related to its investment in 10,000 shares of Rocket Corporation, 40%. In Rocket Corporation, they own 40% of it. So they got 40% of it for $54 per share. So what is that? 10,000 shares? 540, right? $1,054 a share. Well, I guess it is 10,000. You even said it above. And we own 40% of the shares. So how many shares are there in this company? We own 40%. 10,000. What was 40%? Okay. 10,000 is 40%, you guys. How many are there total?
25.
25,000. 10,000 divided by 0.4, right? How do you do that? Right?
Okay.
All right, anyway, and then they said they had net income of 110. Earlier, they declared and paid dividends of 20,000. What method would be used to account for this thing? We own 40%. What is it? It's an affiliate, and we're going to call the method is equity method. That's it. Okay. What is the total number of shares outstanding of Rocket common stock? We just decided 25,000, huh? What we're saying is, look, you guys, some number of shares is 100%. We own 40% of it. We know that 40% of those shares is how much? 10,000. How would you get back to the 100? Some number times 40% is 10,000. Divide 10,000 by 40%. And what do you get? 25,000. So all you do is you take this 10,000, that's shares, not dollars. You take the 10,000 shares, right? You divide it by 0.4, and you will get 25,000 shares. And then to make sure you did it right, you take 25,000 times 0.4, and you're back to 10. I guess. Okay? Everybody good? How do you do that? Okay. 25,000. What is the ending balance in investment in affiliate? Well, all we need is journal entries, huh? What they did in the first place was they debited investment in affiliate, right? Affiliate Rocket Corp. Okay? For $540,000. So that's in that account. They credited cash. That was already written down there. So investment in affiliate was $540,000. Okay. Then what happened? They had a dividend. What do they do with the dividend? They receive it, right? They're paying it to themselves. Everybody agree with that? They're paying the dividend to themselves. They're voting 40% of the stock to pay the dividend. So the theory here is you gave yourself a dividend, right? Debit cash and credit what? Yes, investment in affiliate. You got it. Because I am paying myself back some of that investment, basically, the idea, or some of the earnings from the investment, however you want to look at it. But I'm paying it to myself. How much is that going to be? If I own 10,000 shares out of the 25, and they gave they gave a 20,000 dividend, right? If they gave a 20,000 dividend, what is it per share? 20,000 divided by 25,000 shares. Everybody agree with that? $20,000 dividend divided by 25,000 shares. What is it per share? Is that 80 cents? Okay. How many shares do we own? 10,000 shares. How much are we giving ourselves?
8,000.
8 grand. How much investment have we reduced by giving ourselves the 8,000 cash? 8,000. Everybody got it? That's that. Okay. Then we have 110 of income, okay? So the net income is 110,000. We think we helped earn that. We did, right? 40% of it is ours. So we think our investment's going to go up by 40% of that. That makes sense? Okay. By the way, could I have taken the 20,000 times 40% instead and got the $8,000? Yes. Okay, everybody good? That $8,000, that's a faster way. Do it that way, of course. Okay? So what's 110 times 40? 44,000?
Yeah.
I think I have more investment, so debit investment in affiliate. RC. So if I ask for the journal entries, this is what you do, right? And credit what?
Income from affiliate.
Income from affiliate. Or equity interest in income of affiliate, sometimes called. RC. What did I just do to my investment? I just increased it by 44,000. Okay. So the 40% decrease in the retained earnings of the affiliate reduces my investment. The 40% of the increase in their retained earnings, right, which is 110 income, increases my investment. Make sense? I'm tracking with the retained earnings change. So how much do I have? Is that 572? 76. Well, math skills. Yeah. 576. Transfer. Okay. Easy. What do you have to know? It's an affiliate. It is what? More than 20%, less than 50. That's it. Less than 20, it's going to be what? Marketable securities, either a trading security if I'm going to hold it for up to a few weeks maybe, or available for sale short term if I'm going to hold it for longer than a few weeks, but up to a year, or available for sale long term, it's more than a year. That's it. Okay. You also could have, and this could be bonds too, right? Stocks and bonds both. What are we going to hold the bond for its full life? Investment held to maturity bonds, right? Okay. If I'm going to hold it for less, it's going to be an available for sale security, right? Or a trading security. And what method am I going to use on available for sale and trading securities, on marketable securities in general? Market value. Yeah. Okay. What if I own more than 50%?
Control.
I have control. I'm going to call it a
Consolidation.
I'm going to consolidate, which means combine everything. I'm going to call it a subsidiary. Got it. Okay, we're good. All right, so that's everything. So let's do 10 then. On January 1st, 20C is a long-term investment. They purchased 2,000 to 100,000 outstanding voting shares. What percent do we own? 2%. Where are we at?
No control.
No control. So what is this? It's long-term. Available for sale long-term. That's it, right? Long-term means more than a year. Okay, we bought it for $7 a share, so that's 700,000, right? And they want to know the carrying value at the end of the year. Okay, you don't even have to do any journal entries to get this. This was really easy. What's the market value at the end of the year?
$8.
$8. How many shares do they have?
2,000.
What's the value at the end of the year?
16,000.
What's the answer? 16,000. 4 points like that. Just know what you're doing. Right? What if it said it was 30% of the stock? Well, now it's more like number 9 was. What if it says it's 60%? Now I'm doing a consolidation. Got the idea? Okay, so all you got to do is know what category you're in. So this one's real easy, isn't it, if you know what you're doing? Fast. Let's do the journal entries anyway. Oh, by the way, on number 9, I didn't tell you what the market value was, but what if I had? What would you use that for?
Nothing.
Ignore it, nothing. I don't need it, right? I only need that for the market value, nothing. Okay, here the market value is going to matter. What if I told, I did tell you what the net income is and the dividends are. So what are you going to do with the net income with the market value method? You're on number 10. Nothing, right? I'm glad they have positive net income. That probably drove up the price of the stock. It's probably more money to pay a dividend, right? That's good, right? But I'm not going to record an entry for that. I'm just gonna record the change in market value on it, okay? So let's do the journal entries that would give us that for number 10, okay? Because what we want the carrying value of the investment to be, we already know it's 16,000, right? Let's see how it would get there. So what do you do first? When we do the investment, what would the journal entry be for the investment?
Debit invested, available for sale long term.
Investment in available for sale long term. I hope you guys have some sort of a vague idea of how much more valuable you're making yourself this semester than you were at the beginning of it. I hope you've got an idea how much you're learning. And most of the world doesn't know how to do this. And they're never going to know how. You will. So if you're a doctor too, I can't do open heart surgery, can you guys? I know people that are open heart surgeons and they think it's no big deal. Told you that, didn't I? It's like changing oil, and then they'll think about it. Oh yeah, I can't change oil, but I can do a heart valve for you if you want. Yeah. Okay. Fine. Yeah. So I could change oil. I'm not doing any heart valves. So anyway, although I'd probably screw it up if I changed oil and burn up my engine. Yeah. It's been a long time since I changed any oil. It just got too cheap. You know what's really funny about changing oil? If you go buy the oil yourself and change it yourself, you don't save any money. It's a little cheaper, but not much. How much does it cost to get your oil changed? Is there a place you go?
30 bucks.
20, 30 bucks. What does it cost to buy the oil?
Like almost $20 sometimes.
Yeah, or you might get it for 15.
Yeah.
Let's say I can spend $25 or $30, or I can spend 15. $10 difference, and I'm going to actually climb under there and get the oil out and do something with the oil and clean up the mess and get oil on my hands, and not unless I think it's fun. That'd have to be an entertainment, right? $10 for a half hour of my time? No way in the world. I want far more than $10 for a half hour. Can you change oil faster than a half hour? Yeah. Did you ever work in a place that changed oil? Then you change it fast. Yeah. Anyway, yeah. I guess you can change your oil in 15 minutes, probably. Anyway, so it's $40 an hour, still not working. Right? Would you guys be happy with $40 an hour? Yeah, so change your own oil, right? Yeah, if you're making 40 bucks an hour, do it. Yeah. What I did, the horrible thing was when I was working in corporate accounting and public accounting, is every time I thought about doing something myself, I'd realize I could just work another hour. So I did, and I'd pay somebody else to do it. We had this guy, he drove across, Central Washington University was on the east side of the mountains, Seattle on the west side, and there was a mountain pass that was, the mountain's 10 or 12,000 feet. I think the mountain pass is 2,000 feet, so it's a couple thousand feet, 2 or 3,000, maybe 3 or 5. Anyway, in the winter there's a lot of snow on there. And so his example of how life changes when you become a partner in a CPA firm, or even just successful, he says, you know, this morning I got up and I remembered I was coming here, and then I remembered there'd probably be snow on the path. So when I dropped my car off at the park to the parking attendant, I asked him if he'd go get me a new set of snow tires with my car. I left the keys with him, which he always does anyway. The guy parks the car for him, of course. You're that wealthy. And he says, you know what? I don't know how much I paid for them, but I didn't get stuck. And he says, you know what? Whatever I paid for them is totally immaterial. Right? He says, I bet I make more than that an hour. And then he went on with his talk. What an ass. But anyway, yeah. Because I have to budget for snow tires, yeah. Anyway. Number 10. So, investment in available for sale long term, how much did we pay? 2,000 of them at 7, 14,000. Okay, so we got 14 in the account, don't we? Credit, cash, probably. Okay, that's the investment. What would you do when they report net income? There's invest. So you need to be able to do this. When they report net income, what happens? No entry, we're just thrilled. Okay? So don't do that. When you record the net income, only if it's a investment affiliate. Yeah. Okay? All right. Now let's do the dividend, I guess. How much is the dividend? $200,000. What's our share? 2%, $4,000. What did we get? Cash. $4,000. Did we pay it to ourselves?
No.
No. We're just taking whatever the market gives us, what, in this case, what the company gives us, right? What are we gonna call it?
Dividend revenue.
Dividend revenue or dividend income, either one's just fine.
Is it 200,000 times 2 or 4 or?
2%. We own 2%, right?
Yeah.
2,000 out of 100,000 shares.
Oh, okay.
Okay, so it's, the dividends are 200,000 and we get 2% of it.
Okay.
Another way you could do it is you could take the dividends of 200,000, divide it by the 100,000 shares, and say that it is $2 a share, and we have 2,000 shares times $2. You still get the 4,000. Either one's fine. So just let yourself think, right? Okay, you'll be fine. Okay, it's always hard to do. And what else do we have left? Change in market value. Did it go up or down? It went from 7 to 8. It went up, so what are we going to have? An unrealized gain. What if it went down? Unrealized loss. Does this gain or loss go on the income statement? No, it's a long term available for sale, right?
Doesn't OCI.
Goes in other comprehensive income. You got it. Okay, very good. That other equity section, right? Another category of equity. Okay, you have paid-in capital, right? Common stock, preferred stock, additional paid capital, both. You have retained earnings, and then we also have this other comprehensive income thing, right? Where we put things we don't know what to do with. Basically, is that okay? Don't put that on the CPA exam, please. Okay, there's theory for it behind it, but pretty much what we don't know what to do with it. Okay, so what do we do with this one then? We want the investment to be more, don't we? How much more? $2 a share, no, $1 a share on 2,000 shares, $2,000, right? It went up. So now we've got 14 plus 2 in there, that's the 16, isn't it? Which is our answer, of course. Question, you don't have to do all these entries for this one. And what do you want to call this?
Unrealized gain.
Unrealized, unreal, yeah, unrealized gain on available for sale security. Long term, got it? Now, if it goes down in value, you have to debit unrealized loss, got it, okay? And credit the investment in available for sale long term. We got it, okay? Everybody there? Probably good to go through these. Let's just keep going with them, why not? Mark Corp purchased 1,000 shares of Coins common stock, which constitutes 8% of their voting stock for $50 a share. So what category are we in?
No control.
No control, maybe a trading security, maybe we have a short-term, long-term. Their intent is to keep them beyond the current year. What is it? Long-term. What if it was less than a year? Short-term. What if it's less than a few weeks? Trading securities. Okay. At December 20th, they paid a previously declared $4 million dividend. What are we going to do? Debit cash, credit, dividend revenue for our share, right? On December 31st, Coins stock was trading at $49 a share, right? And they bought it for $50. What are we going to have? Debit unrealized loss, unavailable for sale long term, right? And credit of the investment available for sale long term. And their income was $51 million. We're going to celebrate. We're glad we had income, but we don't know why our stock market went down, but it did, right? Okay, so we have a loss on it, and then we have dividend revenue too, no? Dividend income. Okay, what would the dividend would be the effect on Mark's books? I'm going to debit cash and I'm going to credit dividend revenue. It would increase cash and increase investment income. Yes. Increase cash and decrease investment? No. That's what you would do if it was an affiliate, right? Oh. Would increase cash and increase unrealized gains or losses? Not the dividend, that's the change in market value. Besides, it would decrease, wouldn't it? Well, no, I guess it's a debit to cash. It's still debit cash, but it's credit investment income, dividend income. It would increase cash and increase the allowance to value of that market. Okay? Do you all get that one? Are multiple choice easier or harder? Yeah, I don't know. It's hard to say, So, but that was pretty generous, 2 points for each of these. This one's real generous. What method will they use to account for this investment? Market value. You knew that as soon as you knew it was less than 20%. passive investments, people say this is a hard class too. Can you believe that? Passive investments require use of the market value method for reporting them on the balance sheet. Which of the following statements is false? The market value is more relevant value since the intent in purchasing these investments is to generate cash flow when it is needed. The market value best reflects expected cash flow from the sale of investments. I think that's true, don't you? I put a T next to that. Be careful. I underline the false because I hate these kinds of questions when I take them. You turn your brain inside out, right? You're tempted to answer that because it's the truth. Well, now it's false, is what we're looking for. So that one's true, which means it's not the answer. It is very easy to determine the market value of passive investments since their market value is quoted daily in the stock exchanges on which they trade. It's true unless it's not a very big company. So that one's pretty true. The market value method allows gains and losses to be recognized immediately on all passive investments by deducting them on the income statement. Deducting them? Gains you'd add to the income statement and losses you deduct, so that's ridiculous to begin with. But there's another issue, right? It would only be on the income statement if it was a what? Trading security. Yeah, so it could be a loss and it could be a trading security. So two ways that one's ridiculous, right? And aren't there market value method investments that go to other comprehensive income? Yes. So C is clearly false. Oh, well then it can't be D or E. Answer C. I think you got that. How many even work this? That's what I'm saying when you got it right. One. Yeah. Talk yourself out of it. Did you talk yourself into A or something? Is the best true answer? A is. Yeah. Yeah. So if you read it backwards, you've done it. When I do these, I put a big circle around that false. Good idea. Well, another thing when you're doing multiple choice, always cover up the answers when you read the question. Everybody knows to do that. Do you know to do that? If on standardized tests you're not very good, it's probably because you look at the answers before you work it, and they suck you into answers. So cover the answers and then work it. Then go find the answer. After you worked it. If the answer's not there, now it's an advantage. You get to work it again, right? Because you made a mistake and you can figure it out, right? But what will happen if you read them first is if you read that first, you say, that's a really good answer. Then you read the question, you can make the question fit the answer. And people who write multiple choice questions do that to you all the time. Suck you in, right? What will happen on ones where there are numbers is on the way to the number, they'll give you 4 different numbers or 5 different numbers down there on the answer stems. On the way to the right answer, you'll hit some of those numbers. If it's a well-written question, what's the natural human tendency as soon as you get one of the numbers? Circle it, go on with your life, and you're wrong. In the CPA exam, all the time, you do that. Cover them up. I don't have to cover my mental, I mentally just shut it off. I don't read it. I just look at what I look at. But if you need to, put a piece of paper over it. I'm not kidding. You do it. It'll really help your test scores on multiple choice. And it's true in any class, not just in this one, right? All the answers if there's a well-written question, all of them are logical answers to some really good question, right? They don't give you ridiculous ones. So, all right, 14. The following ratio would be used to evaluate the long-term risk and capital structure of a company. Long-term risk. What relates to long-term risk? You can think about this. I think my investment in my total assets does, but more than it does, don't you think? Long term. I think the total liabilities does. I think the equity does as a whole. But more, I think it's the long-term stuff, maybe. Don't you think? Maybe this. And really, what do you think? Is it this that is the riskiness, or how much of each of these I have that might be a better measure of how risky things are? I think I'm over here. Which one of those fits that? Debt to equity, A. And I made it real easy. Acid test or quick ratio? It's current stuff. Profit margin? Current stuff. Income statement, operations. Cash ratio? Certainly current stuff. Debt equity is the only logic. Okay? Just kind of relax.
Didn't you say not to memorize cash ratio anyways?
Yeah, but for answering the question, you, cash is,
Cash.
yeah, it's current stuff, okay? Yeah. So was that tricky, telling people not to memorize it and then putting it on there? Didn't mean to be. Maybe it is. Which of the following companies is most likely to have the highest inventory turnover? That's interesting. What's that? What's inventory turnover? By the way, I didn't have very many calculations on ratios, but I did have a few multiple choice questions, didn't I? So there's a whole variety of ways I could do this. Cost of goods sold divided by what for inventory turnover? Average inventory, right, guys?
Mm-hmm.
Okay, this is turnover. And it wants to know which of these companies would have a real high one. That's kind of interesting. McDonald's, Kroger, Costco, Rolls-Royce. What do you do? Who turns their inventory over? McDonald's. McDonald's. Clearly McDonald's.
Every day.
McDonald's had better be turning their inventory. Right? Hamburger? I think it's real hamburger, isn't it? You know, with a lot of additives. I don't know. Right? Probably real hamburger. But food, right? Food products. Now, granted, a lot of it's frozen, so they don't have to turn it each day, really. But what do you bet McDonald's needs to be turning their food faster than Kroger does? Remember, Kroger's got all the canned goods. Fresh things, fresh vegetables, fresh fruits, you know, fresh meat, bakery, dairy. Kroger turns fast. What about everything else in the store? Right? It's real slow. Costco? They don't have very much fresh. They're sort of in the same category as Kroger, but they have a far more of their inventory is slower moving, right? Bulk type stuff, that, well, non-perishable type stuff, okay? They have all kinds of things for sale. Rolls-Royce? Wouldn't they love to have high turnover, right? In fact, they have real slow turnover, okay? Give another one a shot. Number 16. Afternoon Corporation gathered the following data. Now, what I really like to do a lot of times, instead of making it easy like this, yes, sir?
What did they do for number 17? That's just blank.
Oh, it's a cash flow statement. Just do the cash flows I've given you. I gave you 2 practice problems, and I've given you a quiz. It'll be like one of those 3, really close. And all 3 of those are exactly the same, really, aren't they? And it's a cash flow statement. So, yeah, it's a full-blown cash flow statement. Okay, what I usually do on this, or like to do on this, I don't know if I usually do, is give you a full set of financial statements, give you a balance sheet and income statement. I don't know if this is easier or harder to have it this way, but anyway, I use this problem in this particular test. What is profit margin? It's my income, right? My net income divided by my what? Profit margin. Divided by sales. So I've got net sales and I've got net income. What do you have to do to get number 1? Take 80, net income. See you later. And divide it by net sales. No kidding. What percent is net income of sales? That's all it is. It's not very good, is it? What is 80,000 divided by 1,100,000?
7.3%.
Okay? Depends on the industry you're in. If that was a grocery store, real good. If that's a diamond store, horrible. Maybe. Yeah, probably. Okay. All right. Anyway, so because you know your total sales, how high they are. You know, right. So yeah, that's not very good. 80,000. Okay, and then we want return on equity. What's return on equity? What's the formula for return on equity, you guys? What is it?
Net income over
Net income.
average.
Over the average stockholders' equity?
Yeah.
Is that what it is? Return on equity? Now, if there are preferred dividends, I don't think I gave you any preferred dividends. You take away the preferred dividends. Why would you take the preferred dividend away here? Because some of the net income goes to preferred shareholders in the form of a dividend. Does that make sense? So a little more sophisticated, we take that out of there. Why don't we have to subtract interest from the net income? Because it's already out of there. the interest goes to the debt holders, right? Okay, so, yeah, so you subtract preferred dividend. On this one, there is none. You don't have to worry about that. And divide it by what? The average
stockholders.
average stockholders' equity. Who owns the equity? The shareholders, obviously. Who gets the net income? The shareholders, okay? Right. So it'd be really the average common stockholders' equity if you have preferred stock. So you take out the preferred dividend, and then you'd also take out their portion of the equity, right? But anyway, so what's my net income? 80. And I even gave you the average stockholders' equity, but you could get it easy, right? You just add together the beginning equity and the ending equity divided by 2, okay, on a balance sheet. What is it, 300,000? Stockholders' equity? Stay the same. Okay, whatever. Anyway, what was that one?
The 0.27.
2.7%?
Yeah.
No, that's more than that, 27%.
Yeah.
80 divided by 300. 27. 27.7. So it is. Okay. Let's see. Earnings per share? It's earnings divided by the number of shares, right? What's net income? 80,000. That's the earnings, right? How many shares do they have? 50,000 shares outstanding? Shares outstanding. How many? That says shares on it. These aren't bad, are they? Shares outstanding is 50,000. What's 50,000 shares divided into 80,000?
$1.60 a share.
$1.60? Yeah. Okay, that's my earnings per share. Okay, got that one. All right. Dividend yield ratio. How much dividends I have out of what? My net income. So now that I have the earnings per share, what does it say dividends are? Oh, dividends are 35,000. I can just do the net income. Dividends divided by net income, huh? What portion of the dividend, the net income, did I pay out in dividends? That's all that is. And that's fine. You know, you can look at it. What's the company's policy? 35,000 dividends. What's net income? 80,000. These aren't bad, are they? What is that?
43.75.
Dividend yield ratio. Okay? You know what? People miss a lot of these questions, but I think it's because they just get burned up and don't study this at all at the end. Dividend yield, the portion of the net income that was paid in the dividend. Earnings per share. Earnings divided by the shares. You know, so, yeah. On any of these, it's almost just what is the definition, which is built right into the name. Return on assets, that's a harder one. Oh, I didn't do price earnings today. Price earnings ratio, what would that be? What's the price? What's the price per share? Market value per share. Divided by what? Earnings per share? So, what's the market value per share? $11. Everybody see it? Do you know the earnings per share? Sure you do. You just calculated it. What is it? $1.60? Is that right? What's the price earnings ratio, everybody? $11 divided by $1.60. What do you get? What is it? 6.875. So it's 6 to 7 is the PE ratio. Times. Right? It's number of times.
What is it?
6.875. 11 divided by $1.60. Does that sound right? Okay. So again, what does that really tell you? This year we made $1.60, and right now the market price is 11. That's what it tells you. Yeah, basically. You know. So is that good, bad, indifferent? You got to know more. Okay. On this company, I don't like this company very well. Look at their sales and look at how crummy their income is. But maybe the market thinks things are going to get a lot better, and that's why it's at least that high. And you think it's going to come up. Or maybe it's dragging down. It's pulling that price per share down. It hasn't completely fallen yet. Could be either one, could it? So you have to really study. You know what? If there was some ratio that would tell us what to invest in, there'd be no room for any of us to have careers. You just calculate the ratio and invest and get rich. I told you about Will Rogers saying about making surefire way to make money in the stock market. Did I mention that to you? I just love this one. It's really nice. He's an old-time storyteller, philosopher, American philosopher. Anyway, well, entertainer and philosopher. Will Rogers said, sure way to make money in the stock market is you buy a good stock, wait for it to go up and sell it, make money. If it don't go up, don't buy it. True. Just don't buy ones that aren't going to go up. Buy the ones that are going to go up and you'll get rich. That's the game, right? So, you try. Let's see, return on assets, what would that be? Return on assets is a little different, isn't it?
That's like net income minus interest.
This one, yeah, this one's minus.
Is it what are divided? Plus.
Here's what we got.
Someone
Let's think about this thing, yeah. It's plus.
Something.
Okay, what do we have? Got assets, liabilities, equity. Return on equity was what? Net income
Yeah, right.
divided by the average equity, right?
Yeah.
Average stockholders' equity. Okay. What's the return here on the liabilities? That's your interest minus, or times, I'm sorry, 1 minus the tax rate. Because the government pays for part of your interest for you, right? Divided by the average debt. So this is called cost of equity. This is called cost of debt. Later, we're going to use that for now. Okay. By the way, why do we use K for cost? Because in economics, C means consumption. K means cost. Like it? So, econ classes you're taking? Yeah. Okay. Anyway, terminology is a little different. Sorry. The weighted average of these, the weight of the debt times the cost of the debt, and the weight of the equity times the cost of the equity, when you add that up, you get the cost of the assets. So what's the formula for the cost of the assets? For the return, see this is return on equity. I guess that's return on debt. Nobody calls it that. Return on assets is what? What are you going to have to add together? You got to add back the interest, don't you? So it's the net income. How'd the authors do it? They didn't just add back the interest, they added back the after-tax cost interest, didn't they? So it made it hard. Is that right? Does somebody want to look at that page? He's got it out there over there. What's the formula for the authors use for return on assets? Net income plus interest.
Expense, net of tax, and then over average total assets.
Yeah. They did it right. Average assets. Okay, so this is the toughest one. But do you see why it is? The debt holders earn the interest, but then we get the tax benefit of writing the interest off on our tax return. And the stockholders get the net income. So you add those two together, that's what you earned on all of your assets, huh? Make sense? So let's try that. What's my net income?
80,000.
What's my interest?
125,000.
125,000?
Yeah.
What's my tax rate?
40%.
40%. So what happens is for every dollar I put on my tax return of expense, the government reduces my taxes, right? For every dollar I put on my tax return of expense, my taxes go down by 40 cents, right? So if you put 125,000 on your tax return as an expense, what's going to happen? Your taxes are going to go down by 40% of that. So what's your net cost of the interest?
That's
60% of it. That makes sense? If I'm paying 10% interest and the government picks up 40% of it, what do I really pay? 6%, right? This is all that's happening here. And we'll really work on this in later classes. Okay? So does that make sense? Any expense I put on the main income statement, the government's going to Pay part of it for me, as long as I'm taxable. What about any additional revenue I put on my income statement? Government's good about that one too. What do? In a 40% tax bracket, they're going to take 40 cents out of every dollar, right? That's how it works, okay? Normal. It's how we fund society, actually, which is a good thing, I think. I like having a society, you know, roads, bridges, schools, whatever. Yeah. It's how we fund the Young Center. Tax dollars. It is. Yeah, big bet. It's not just the people going there. I always make jokes about that. I can't afford to go there, but I get to pay taxes for it. I don't know if I've ever paid to go. I guess I've paid a couple times to go to the Young Center. Usually I get free tickets for different things. Cheap. Anyway, I don't like concerts at the Young Center. I know the acoustics are pretty good for a great big monster building, but you know, we have the Brown, we have here, and we have different performance places. Have you been to the Palace for a concert, you guys? Yeah. Have you been to the Palace? Nobody should ever do a concert at the Young Center. What do you think?
I like outdoor concerts though.
Oh, that's nice. Yeah, especially if you have wine. No? No. Oh, yeah, yeah. No, I do like outdoor concerts. You're not, are you 21 yet?
In some states.
In some states, you're 21?
Yeah.
Oh, okay. I like that. That's good. All right. What are the average assets, you guys? I just gave them to you as average assets, didn't I? No, I didn't.
You get current assets.
How do you get your assets? This was hard. How do you get your assets? Anybody know the total liabilities? I do. Anybody know the total stockholders' equity? I do. Yeah. What if you added the total liabilities and the total stockholders' equity together? You know, 250 plus 300, what would you get? 550. So that one was kind of tough, huh? Everybody see that? Yeah. If you got the total assets and the total equity, you got it made. So 550 into what? What's 125 times 0.6?
25.6. 75. Wait, well,
That might be.
25 times 6?
Yeah, times 0.6.
Oh, okay. That's 75.
75 plus 80, right guys? 155? Is that what that is? Divided by 550? What'd you get? What do we get here for return on assets? Everybody see what's going on? 80 plus 75 is 155 divided by 550, right? Assets. What's your return on assets?
28%.
Is that what it was? 28 point what?
1.8.
28.2%?
Yeah.
Okay, what's your return on equity again? What did we calculate when we did return on equity? 27.7? This is not good. Their cost of debt's really high. Whoever wrote this problem didn't do a very good job with it. Because the return on equity is more than the return on assets. That means our debt cost is even higher than 28%. So, all right. A few of those. What else do we do? You know what we could do is we could look at. Oh, there's all the quizzes, all the tests. I'll do that. I'll do that when we finally do it. Which quiz questions did you ever tackle? You want to do a few of those? Oh, would anybody like a blank quiz or a blank test to use to study with?
Sure.
There's a 10 and 11. A 10 and 11. I have 12. Anybody else wants 12? They're kind of handy, they're blank ones. So, there's 4 of them. Anybody else want to know? 12? 12. I give you a 12. I give you a 12. You want? Okay, did I give you guys 12? Or did you 11?
No, we got it.
That's why it was just handing me this round.
Okay.
Yeah.
Oh, that's what we got to.
So, want to do anything from the quiz 10 and 11 we did in class? Or from the 12 and appendix C? You want to do the cash flow statement? Yeah. Is that what you're going to say? Do a cash flow statement? It's kind of easy to get screwed up on that, isn't it? When you get started, things don't fall in place. I think the best thing to do is just don't panic. And if it doesn't work out, move on, right? And if you have time left at the end, like on the final, you probably would, go back. So try it the first time. If it doesn't work out perfect, don't burn a whole bunch of time, right? Move on. Write down everything you know, and then write down, this total should agree or something, and go back and do something. Probably you just screwed up one thing. So let's go through this thing. This is a good one. This is real similar to what we're going to have on the test, of course. So, if I can find the problem. Here we go. All right, so a lot of times what I'll do is give you a balance sheet and an income statement, and some of the practice problems were that way, weren't they? I kind of prefer that myself when I work it, but what this did was it just gave you the change, didn't it? So it saved you the trouble of subtracting, that's all it did. Okay, and give you the change in each account. But then it's kind of hard to find all the information, I think. So, okay, if I was going to do a cash flow statement, right away it says, using the indirect method, prepare a statement of cash flows. So they're at the end, right? Required. What do you want to do? Put the company name at the top?
Yeah.
The Lang Corp. And in real life, you spell it out, by the way, because there are companies that are actually named Corp, and there are companies that are named Corporation. No kidding. Right in their formal name, so you always write it perfectly. For our purposes here, I don't care. Okay, then we're going to call it a statement of cash flows?
Yep.
Or cash flow statement? When you're in Dex class, ask him if he wants you to fill it out properly, right? If he says in good form, he means perfect, okay? And then you'd put for a period ended, right? Because we started at the beginning cash and worked down to the ending cash. For your ended in the date, I don't think I gave you a date on this, did I?
No.
That's the date, whatever it is. Okay? We got 3 sections, so we go down the page, don't we? We start with
Operating.
cash flow from operations. Or operating. We go down about half the page, so I'll pretend I'm going on down the page. And what do we have? Okay, these are upside down, right, guys? And then we go down about 3/4 of the page, and we are financing. Okay. And then at the very bottom of the page, increase or decrease in cash, right? Okay, whatever it is. What happened here, anyone? Cash decreased, right? So we say decrease in cash. With brackets around it. 30,000. Okay, beginning cash, did they give me beginning cash?
Yeah.
Didn't it? Yeah, down below somewhere it says beginning cash was 100. There's the number C. So what's the ending cash? 70, obviously. Yeah, points building, guys. Okay, and you've done any thinking yet. Okay, everybody good so far? You should put a check mark next to cash so you don't write it down again. I had a few people do that in the quiz. Don't do it again. Okay, obviously we explained the change in cash, it's there. Okay, where do you want to start? I don't really care, right? Go in any order you want. Just make sure you take care of one account at a time, right? Do the whole account.
Change in current assets.
Okay, he wants to put the change in current assets. Leave some room at the top up here because you're going to want to put what? Net income and depreciation.
Does it matter what order it goes in?
Yeah, you should put net income first. I won't mark off for it, but you should. You know, we would put the net income first, then we'd put the depreciation typically, and amortization, and then we put the gains and losses probably, right? And then we'd put all the changes in current assets and current liabilities. So let's leave some room. So we have room up there to put it. That's better form, okay? It's all over the map what people do though. So changes in the current assets and changes in the current liabilities. You say you want to do those first? I think that kind of makes sense, okay? All right, so what do? Which one are the current assets? Yeah, so I'd say increase in accounts receivable. If I have more accounts receivable, that means I did not collect all the cash from my sales, right? That's all it is. Okay, so if you have 20,000 more accounts receivable, what happens to cash? Went down. That's it. Okay, but brackets around it. I have less inventory. So I sold inventory, I have cost of goods sold on my income statement that used no cash because I didn't replace it. If you didn't replace your inventory, you have more cash than if you had. That's all. So decrease in inventory. These are current assets. That's why we're putting them here. Aren't you glad you know current from non-current? Right? It's just a year less. It's current. A year more. It's non-current. Prepaids also current, right? There's an increase in prepaids. What'd you buy them with? Cash. You have less cash. See you later.
Thanks.
By 10,000. Right, guys? That's it, isn't it? Okay. Good. Now we're to long-term investments. So if we're going to do the current stuff, we'll stop. But you should now have a check mark next to cash, accounts receivable, and inventory, and prepaids, right? So we've done a bunch of them, and boy, are we accumulating points. So let's come back to the long-term investments of plant and equipment, because we might buy and sell both, right? And where are we going to put them anyway? Under investing, because that's what we invest in. Oh, I said earlier this is upside down. What do you do first? You obtain your financing from equity holders and long-term debt holders. Then you go buy your non-current assets, right? And then you run your business, that's operations. I think it's upside down. It's fine, but it's the way I remember, or try to get you guys to remember the order, instead of just memorizing it, is, wow, it's upside down, right? From the way I do things. But maybe operations is more important. I don't know, I suppose it is. Right? Maybe that's why it goes first in the state. It's the way it was designed anyway. Okay, so let's go to the current liabilities. Oh, what about accumulated depreciation? We go down underneath the credit accounts. That's going to go with property, plant, and equipment, right? So let's do nothing right now. Okay? Accounts payable? That's current liability, isn't it? So what it went up? Yeah. Yeah. See you later. Increase in accounts payable. What does that mean? I borrowed money. I have more cash. Right, guys? If the current liability goes up, I didn't pay the bill. So I have more cash, right? Okay. So that would be 30,000. 30,000 more cash. So it's just the opposite of the current assets. If the current asset goes up, I have less cash. All of the things held equal. Current asset goes down, I have more cash. Huh? And you sold it for cash. If a current liability goes up, I borrowed cash. If it goes down, I paid it with cash. Okay? Just mirror image of each other. You know that because assets are debits and liabilities are credits. They have to be the opposite of each other. Right? Okay. And those guys ran out of energy early, didn't they? I'm not staying by myself. Okay. All right. Anyway, accounts payable. Accrued liabilities up or down? I know everybody has someplace they got to be. I have someplace I have to be too. I'm going to go to my grandson's basketball practice and watch because I can't play basketball. Coaches want me to get out there with them, and I'm like, what do I do? I get 10,000. Increase, I borrowed money, didn't I? Okay, good. Oh, by the way, we checked off accounts payable. Now we check for accrued liabilities. Taxes payable, also current liability. What happened to it? That went up by 10 too. I borrowed 10 more. That's making you nervous by now, isn't it? Right? They're all going the same direction. They are. Bonds payable? That's non-current. Okay. Although there's deferred income taxes, and what does this author like to do with deferred income taxes? Which is real common, by the way. They think that's part of operations, huh? Okay, so if you remember that, you could put it up under cash flow from operations. Increase, was it? It didn't go up, didn't it? No, it's a decrease. I take it back. And we'll go over this some more. Decrease in deferred income tax payable. What do we decrease that liability with? Cash, right? So I have less cash because it went down. What if it went up? I have more cash than my tax expense implies. We'll come back to that. Okay, I don't know if we know what our tax expense is here. Maybe we don't. Maybe I can't show you that. Yeah, but that's what would happen anyway. A decrease in deferred income tax payable, I'd pay it with cash. Put a check mark next to that. Okay, what do you want to do next?
Net income.
Okay, put in the net income, but when you put in the net income, what account are you starting to analyze? Retained earnings. So he wants to do retained earnings next. So we'll do retained earnings next. That's good. Okay? So net income is how much? Does it tell us?
That's what screwed me up.
It doesn't have it. Oh, but I know I want it. What do I need to do? What could happen here? I probably have a beginning retained earnings. I probably have an ending retained earnings. Did they tell me what the beginning and ending retained earnings were?
Minus the change.
No, just the change. What's the change?
45.
It increased by 45, right? Credit, total of 45,000. You guys agree with that? I gotta go. You know, if it was 100 at the beginning, it's 145 at the end. Whatever, okay? Whatever, that's 45 more. What are the two things that could change it? Increase with net income. So net income will increase it, yes. So net income's at least 45. Everybody agree with that one? Okay, then what would decrease it? Dividends. Did they give us a dividend? Yep.
35,000.
How much was it?
35,000.
35,000. If this was 35,000, you took 35 out and somehow it went up by 45, what's the net income? It's 80. And once you see it, it's kind of, oh my gosh, I really missed that. Yeah, well, write down that T account, right? Okay, just analyze it. Okay, so 80,000 is my net income. But if I'm going to put the 80,000 net income in here, which of course I have, do I need to put the 35,000 dividend in? Yes. And where does it go? See you later. Cash flow from financing activities, right? It's returning some of the owner's investment, right? So what we've got is dividend declared. Actually, this one was declared and paid both, wasn't it? Because there's no dividends payable. So what do we got? 35,000? That's cash out, isn't it? You guys with me? So now you got it? Okay, not bad. Okay, I guess now we can check off retained earnings. Want to do common stock over down there? What happened?
Increased by 40.
Yeah, so what does that mean? They didn't give us any other information, did they? They didn't buy any back, they just issued stock, didn't they? Oh, they issued stock. Debit, cash, credit, common stock. Where does that go? Financing. Long-term debt and equity go under financing, right? Okay. Non-current assets go under investing. All the current stuff in the operations and the net income, revenues less expenses, the net income go under operations. Okay, so this would be issued common stock. I have more cash, right? Debit, cash, credit, common stock. Remember, you're always reflecting what happened to cash, not what happened to the other account, right? Credit, common stock, it's debit, cash. Okay, so now you can check that off. I guess bonds payable we should do. We haven't done that one yet. That's the nice thing about checking them off, isn't it? What happened to bonds payable? Does it say anything down below about bonds payable? No. So it increased, or it decreased by 40, didn't it? So did they issue any if they don't say anything? Probably not. What they did was what? Paid them off. Okay, so paid or retired, whatever you want to call it, bonds payable. How much? 40,000. Debit bonds payable, credit, cash. Right? We got that one. So now you can do bonds payable. I guess long-term investments now. Only got a few accounts left. What does it say about long-term investments? 60 were sold for 80,000. So on long-term investments, we're going to have to do a little bit of work, aren't we? Long-term investments. Okay. What did it start with? Oh, we don't know. What happened to long-term investments, though? The difference between the beginning and the end is what? Is 50? Went up by 50, didn't it, guys? Agree? I can actually say guys now. 3 guys left. Get away with it. Okay, 50? Okay, long-term investments went up. And they sold how much? 60? So 60 came out of long-term investments. Did everybody agree with that? Credit long-term investments by 60. and it was sold for 80. Debit cash, think so? And what's the 20, everybody? You bought them for 60, you sold them for 80. What is it?
Gain on sale.
Gain on sale. Where's the gain gonna go?
Operating.
Yeah, it's on the income statement. Included in that 80 up here is 20 from that gain. We don't want that gain there. Where do we want it? Under investing activity, it's a long-term investment, non-current asset, right? So here's what I'm gonna do. I'm gonna add back, or I'm sorry, deduct out, deduct gain on the investment, right? Selling the investment. That's 20,000. Got to take your 20 out of there, don't you? That gets this one, okay? And then I'm going to put the cash that I sold it for under investing activity, right? Sale of long-term investments. This is kind of tough. So let's think about this. What happened? 80 increase, 20 decrease in cash. Ta-da! Difference is 60, right? Which is the change in long-term investments. It's not that the 20 gain is not really a gain. It's that the 80 includes the 20, and I only want operations over here, right? Cash flow from operations. That making sense? That one's kind of tough. And then, so now we can check out that account, and what we've got left is plant and equipment, don't we? And this one's always kind of a pain. Let's get ourselves a little more room here. Okay, so let's do plant and equipment. Okay, what do you know about plant and equipment? Plant and equipment. Accumulated depreciation go together, right? What's the change in plant and equipment? Beginning to end?
Increase in plant.
So I bought at least how much? 120. Could I have bought more than that? Yes, if you retired, right? Everybody good? Okay. Accumulated depreciation between the beginning and the end, what happened? Went up too, didn't it? Went up by 40? You guys with me? Okay. So if that went up by 40, what's the minimum my depreciation expense was? 40. Could it be more than that? Yes, if you retired some. So what I want to know is how much would I debit plant and equipment and credit cash when I purchase assets, right? What's that entry look like? Then I want to know what's debit depreciation expense and credit accumulated depreciation, don't I? What does that entry look like? And then there's possibly one other entry. What is it? I could sell some. If I sell some, what is it going to look like? So,
Cash.
debit cash for whatever I sold it for. Credit plant and equipment,
Gain or loss.
maybe a gain or loss, right? And one other piece,
Appreciation.
accumulated depreciation if it's building or equipment, right? If it's land, no. No accumulated depreciation. That's true, isn't it? Okay? Those are the possibilities. So I have an increase here for buying something, and I have a decrease here for selling something, perhaps. I have a decrease here on the accumulated depreciation for what I sold. Those two are going to go together. And then I have an increase for my depreciation expense. So what kind of information did it give me? Oh, this gave me the beginning and end. That was not necessary. The beginning is 500,000, right? The ending is 620. There's the 120 increase. They didn't need to tell me that, did they? Right? On the accumulated depreciation, the beginning was 200, and the ending is 240. Well, I knew it went up by 40. They didn't have to tell me that either. Right? But it's fine. Doesn't make any difference. Do I know anything else? Do I know what depreciation expense is? No. Do I know how much I bought of equipment? No. But look at A. What do I know? I sold equipment for 40,000. Debit 40,000 here. Am I right? Debit cash. Equipment cost 120 when purchased. Credit plant and equipment for 120. Am I right? and it had 70 of accumulated depreciation. Debit accumulated depreciation for 70. What was the book value of this equipment that you just got rid of? 120, that's the cost. Less 70 accumulated depreciation, book value is 50. Good. I sold it for 40, what happened to you? You lost 10. Yeah, there you go. Lost on 7. Treating you guys like you're intermediate students. That's good because you're close. Right? Ready to do it. Just take 102 seriously. You'll be fine. Okay, are we good? So now what? What do I know? I have a loss here. Where do I want to put that? Up under operations. Add back the loss, right? That's because the 80 includes the loss, right? The 80 net income includes the loss. And I want to put the loss over under cash flow for the investing activities. I don't want it here. That makes sense? So we add back the loss. It's not that a loss generates cash somehow, right? It's just that I want to move it to the other place. Add loss on equipment, okay? Sale equipment. 10,000. We got that one, okay? Then what do you want to do? Well, I also want to pick up this cash of 40, don't I? Where do you want to put it? Non-current asset, where does it go? Investing, that's what I invest in. Sale, it was equipment, wasn't it? Equipment. What did I sell it for? Sold it for 40. Okay, so let's put the 40 in. Okay, now what have I explained? Now let's look at this. I have a debit to accumulated depreciation of 70. So I've explained that, right? And I have a credit to equipment of 120, was it? Okay, I've explained that one. I have explained both of those. It's a 50,000 change, right? And what have I put on my cash flow statement? 10 plus 40 is 50. So, got it? So what else do I have to explain?
Depreciation.
Yeah, depreciation. Well, let's do that one. If I started at 200 and I took 70 out, it's now 130. Somehow it got up to 240. What's your depreciation expense? 110. Over there. Okay? So I must have credited accumulated depreciation for 110 and debited depreciation expense for 110. There's no cash there, but remember what happened. That depreciation expense came out of my net income and it used no cash. So I'm going to add it back where? Back to operations. It'll be the item under net income. Depreciation and amortization. Expense. It's not the balance in accumulated depreciation, it's the expense for the year, right? 110 was it? Okay, good. Okay, now I've picked that one up. What's left? Oh, this entry, huh? What's that? How much did you debit plant and equipment for? If you started with 500, you took out 120. That would have made it 380. Now it's 620. How much did you add? It went up by 120. You took out 120. It's 240, isn't it? So the purchase of equipment is 240, isn't it? Must be. Debit plant and equipment 240. Credit cash 240. Everybody got it? Where am I going to put that? Well, it's cash going out. Under investing activity. Purchase plant and equipment. I don't know which one it is. 240. And I had less cash because of that. Okay. Now, you can check off now plant and equipment and accumulated depreciation. And how many accounts do we have left? None. So just make sure you do every account once and only once, right? Just remain calm. You do these, right? Okay, give me the total. No, I don't want a double underline. You just want a single there. Total cash flow from operations. Over here, we'll do total cash flow from investing. Here, we'll do total cash flow from financing. And when we're done, they are going to all add up to what? The decrease in cash, 30,000, right? So give that a shot. Go ahead and have it. I guess I can't show you what's going on with the deferred income tax because we don't have an income statement, right? It's, well, I'll make up a number. In fact, we can do a little thing real quick. I guess we're burning out early, that's good. You guys want to stay another hour? I will if you will. We'll do something else. Go ahead and just go study that school. What'd you get for total of anything? This one's cash flow from investing is a negative 120, isn't it? Is that right? 80 plus 40 less 240. And this one's 75, and this is negative 55 for financing. What was the last one from operations? What'd you get? Let's make sure we did everything right. Anybody, did any of you have a number yet? What'd you get?
A total decrease of 19,000, so I'm 11,000.
Oh, you're 11. Okay. Well, maybe I screwed something up.
Should be 205, right?
Should be 255. Did you get 255? Oh, wait a minute, I did something wrong.
But that doesn't even.
Oh, we didn't put something, I left something out.
That doesn't even.
Oh, we didn't do it. Ah, long-term investments, I didn't finish it. That's what's wrong. You know what's kind of cool about it, though? Is when you get these answers and you add them up, it's not going to hit the 30, is it? So then you realize something's wrong. So what did I screw up? I took the sale of investments out, but I didn't have a purchase of investments. It went up by 50, you guys. I sold 60 and it went up by 50. How much did I buy? I can't believe you guys let me get away with that. Investment in long-term investments, right? That's kind of silly. I just call it long-term investments. How much does long-term investments go up by? If you took 60 out, and it's gone up by 50 during the period, what'd you buy? 110. There you go. That's how much we're off by a bet. Okay, so we got 110. Where does that go? Purchase investments. 110 credit. So it wasn't 120 decrease. What was it? 230. Let's try that. Okay. And what'd you get under cash flow from operations? We get a 255, somebody said? Okay, so we did do it right. Left out a piece. But we'd have caught ourselves, wouldn't we? Right, guys? What's 255 less 230 less 55? Negative 30, isn't it? So, you know, even if you make a mistake, if you only left one or two things out, fine. Okay.
Would that say something invest for the 110?
Yeah, purchase investments. Purchase investments. The one above it's purchase plant and equipment, and that one's purchase investments. Make sense? Let's expand the problem a little bit. Let's use this 80 net income and this 5 decrease in deferred income taxes, okay? And let's think about how that might work, okay? What was their entry like? Well, let's see. My net income is, what did I say, 80,000? Let's say I'm in a 35% tax bracket I hereby decree, okay? So my tax expense is 35%, which makes my net income be what? That's 35% of my net income before tax, right? Stretch your brain a little bit. Now you're really tired, okay? If tax expense is 35% of net income before tax and my net income is 80%, what is this number? net income before tax is 100% of itself. If tax is 35%, what's net income? 65%, right? Can you tell me what net income before tax would have to be in this scenario? And therefore what my tax expense would be? Sure. What do? Some number times 65% is 80, right? So divide 0.65 into 80 and you're back there, aren't you? So what was net income? This is not in the problem, I just made it up, okay? What's the net income before tax? It's 80 divided by 0.65.
120 or $123,076.93.
076?
Yes.
Okay, that's it. Must be. Just to make sure, take that times 0.35. If you take 123,076 times 0.35, do you get $43,076?
Yeah.
Yeah, perfect, huh? Okay, so if you knew this were the case, what must their journal entry have been? It must be that, this is on their financial statements, right? It must be on their tax return. How much is the tax paid? Can you figure it out with this information? What did they do? They debited tax expense on their financial statements for how much? 43,076 in the little scenario I just gave you. And what happened to deferred income tax payable? It went down, right, by 5,000. How much tax must they have paid? Really, at the time, they probably would have gone to tax payable, income tax payable, current income tax payable, right, versus deferred. So this would be the current tax payable. But later, they pay it, so it'd be cash, right? So that must have been $48,076. What this means is what? That's the tax paid with the tax return. What this means is you've reversed some of your timing differences on that deferred income tax. And later we'll work with deferred income tax a lot. Okay? It'll drive you crazy. Trying to keep it straight. What's that caused by? Modified accelerated cost recovery system for depreciation mostly, right? Could be other timing differences too. Or you either recognize the revenue on the tax return sooner or later than on the financial statements. You recognize expense sooner or later on the tax return than on the financial statements. So you end up with deferred income tax payable or deferred income tax asset. Or worse, both. And current long-term versions of both. Yeah, so crazy. It's current or long-term debt based on when it's going to reverse. I pay the tax next year. It's current later. It's not enough. Burned up. Any questions? Burning questions? Something you want to really look at?
Can we do B and C on this first practice set? That's the only thing I missed.
On the first practice?
Oh, I'm sorry, on the relevant appendix E.
Oh, B and C on what?
The
For the last quiz.
Number 1?
Yeah.
Oh, okay. Oh, I guess I didn't. Yeah, I didn't work that. And you know what? I changed this problem and I didn't need to. I don't know what I was thinking. There was enough information to work it. You want to work that one both ways, maybe? That'd probably be worthwhile. But let's go ahead and work the way I changed it. The way I changed it to. I said you have a 30% interest and you ignore that journal entry, right? So if you have a 30% interest, what method do you use? Equity, obviously, right? How many shares are there? If 9,000 shares is 30%, we own 9,000. If 9,000 shares equals 30%, how much is 100%? That's all that asks. Take 0.3 and divide it into 9, and what do you get? 30,000? That's it. That's all you did. Take the 0.3 and divide it in. Some number times 30% is 9,000, right? So divide 9,000 by 0.3 and you're back there. And then just make sure that 30 times 30% is 9. You did it right. Did I do it? What is the ending balance in investment in affiliates? Okay, so what we want to do is investment in affiliate. Everybody that watches this at home, this is number 1 on quiz 12 in appendix E. Sorry. Okay, so investment in affiliate. What do we start with? Well, they said they got 9,000 shares for $40 a share. How much is that? It's debit investment in affiliate and their name, right? For 9,000 times 40 is 360, is it? Credit cash for 360. So you'd have that first. You don't have to write the entry, of course, but it's 360,000 comes in here, right? And then what happened? Well, they reported income of 120. How much of it do we own? 30%. 30% of 120 is what? 36,000, right, guys? Debit. I earned it. Debit my investment, right? Investment in affiliate. Are you guys staying with me? You know, if they earned 120 and I own 30% of them, 36,000 is mine, right? That's how much I think my investment goes up. And credit, income from affiliate, is that right? Okay. 36,000. So I have 36,000 more. Their increase in retained earnings was 120,000. My share of that is 36. That's what I'm doing. Okay. Then it says they pay dividends of 18. Well, how much of the dividends do I get? I'm going to get 30% of 18, which is how much? 18,000 times 0.3. 5,400, is it? And I'm going to call that what? Oh, I'm paying myself back part of my investment. This is equity method, right? Investment in affiliate. For how much? 5,400. Okay, so that reduces it by 5,400. They reduced their retained earnings, the company having the investment in the affiliate, right? They reduced their retained earnings by 18, but my share of that's 5,400 coming out of my investment, right? So I've got 360 plus 36 less 5,400 is 390,600. And I gave 6 points for that one. That was the tough one, of course. Okay? Let's work it the other way. Okay? What if I had not changed that problem? Which I don't know why I did. But if I had not changed it, what would we have done? How would you get this thing? Well, still, if it says Book Corporation recorded the following journal entry for 9,000 shares. So that's obviously 9,000 shares, and it says the stock was purchased for $40 per share. Sorry. Hello? Hi. I'm in a review session for a minute. Oh, no. All right, are you out there at the Karen kids? Okay, we're gonna quit here in about, I don't know, 5 or 10 minutes. And then I'll be heading. All right, good. I will do that. Yep. Bye-bye. One of my grandkids is sick. Takes a long time for premature kids to really recover. Okay, anyway. So what would you have done with this? It made it a little harder. What would you have done with this thing? What do we know? We know that they recorded a journal entry, so that they have 9,000 shares at 40. By the way, could you figure out what their entry would have been to buy the stock if you knew it was 9,000 shares at 40? Well, sure, it's the same entry, right? Debit, investment, in affiliate. For 90 times 40 was 360, right? So this would be the same, credit cash. Okay, we just don't know what percent of the company that is, okay, at this time. But then they said they debited investment in affiliate, credit income from affiliate. What are they doing there? They're recording their share of the income. So how much was the income of the affiliate?
120.
120,000 is the income. And how much was your share? 54,000. I can figure out what portion I recorded as income, right? You guys with me? Because they wouldn't have made that journal entry debit investment in affiliate and credit income from affiliate unless the affiliate made income, of course. And they'd only do it for their share, right? So if this is 54,000, all I'm saying is, well, the total company was 120, our share was 54, so what was the income? Or what was the percentage ownership? 54 divided by 120 is what?
45.
Yeah, so 45% was the answer that I was looking for, okay? For the ownership. Oh, I guess I didn't ask for that, it's 54. But then how many shares must there be? Our 9,000 shares equals what? 45% of the stock. There you go. So what's 100%? Divide 0.45 into 9, and how many shares did you get?
20,000.
20,000. So it must be 20,000 shares. That is a bit tougher, isn't it? Right? A little bit. Okay? You had already worked it, I think.
Yeah, I did it a little different though.
But you got the same answer?
Yeah.
Okay, go. All right, so 45%, okay, and there's 20,000 shares. Cool. Okay. So now what would we do? We want to know what the balance is in that investment account. That's the third part still. So investment in affiliate. Okay. We had 360. We added 54. And there's going to be one more thing, of course. What did they do? Paid a dividend, didn't they? Right? So what would the dividend be? Here's the investment. Here's our share of the income. And then our share of the dividend. We're paying ourselves a dividend, aren't we? It would be debit cash, wouldn't it? And credit what? Investment in affiliate. True? Is that true? And what was the dividend in total? 18,000. What's our share if we own 45% of the company? 8,100. There we go. So you could have done this one too. Okay? So credit. That made it a little challenging. 360 plus 54 plus 8,100. What would the answer have been? I don't know. 414 less 8,100.
405, 900.
Tough. Okay? Does that do it?
Yeah.
Both ways. All right, Dave.